Now we are proceeding for solvency ratios. Solvency ratios are so important part of financial analysis. As analysts, we need to understand, is this company able to pay back its debts or obligations in long-term period? If the business or company is able to pay back its long-term obligations, we can easily say this is solvent company. So solvency ratios are the tools to judge the ability of the business to pay back its debts in long-term period. So here are different formula like debt to equity ratios, time interest earned or interest coverage ratio, and third is debt to total assets. Let's discuss one by one debt to assets ratio. Here, the formula is total debts. We will take total liabilities from balance sheet or statement of financial position. And in the denominator, there is total assets. So total asset is also taken from the statement of financial position. So I have taken 3 years data from a public limited company. So this is basically a practical analysis of a company. Here you can see debt to total assets. So what does it mean? 0.08, 0.12, and 0.12 for 2017. So debt to total asset ratio tells us in our total assets how much debt has been taken from outsiders or from external party. You can see in 2019 they took 0.08 debt for every $1 of total assets. In 2018, for every $1 of total assets, they have taken $0.10 as debt. So external parties have claim on our asset only up to 12% approximately, or you can say every $1 of total assets contains $0.12 as our liability or obligations. So here is the graphical representation of debt to total asset as compared to 2017. The ratio is not higher as compared to 2017 and 18. Now there is another formula which is debt to equity, very famous formula, debt to equity. I already told you what does equity mean. Equity means shareholders equity. It is calculated as total share capital plus all reserves and surpluses. So debt to total as debt to equity ratio tells you the widespread of capital structure of the business. It means in our total capital structure, how much debt has been taken. So 0 point, so formula is total liabilities over total shareholders equity. 0.23 in 2019, debt to equity. So in our total capital structure, the portion of that is 0.23. And in 2018, in total capital structure, the portion of that is 0.34. It means as compared to 2018, we have taken lesser debt in 2019. But in 2017, we have taken 0.35, which is almost equal to 2018. So here is the graphical representation. As compared to 2017, we have taken lesser debt or capital structure is less leveraged asset. Now the last portion of our solvency ratios is interest coverage ratio. Basically, interest coverage ratio tells us how many times from our current earnings we can pay or bear our interest expenses. So basically, interest expenses is also known as financial cost of the business. Financial cost mean if you have taken loan from a bank, then you have to pay fixed amount of fixed percentage of interest. So this interest, how many times we can pay from our current earning? I have taken hypothetical figures here just to make you understand. $200,000 is our earning before interest and taxes, which is also known as operating profit of the business. So operating profit is $200,000 and fixed interest is $2,000. So answer is 10 times. Here 10 times mean 10 times from our current earnings we can pay our interest expenses. So if this ratio is 10 times in this year, and in previous year it was 8 times, and in the year before previous year it was just 5 times, it means over the years we are getting improved in our interest coverage ratio, which is a good sign of solvency ratios. Thank you very much for watching this video.